Welcome back. Today, we're looking at a financial analysis on Akari Therapeutics. It argues that a recent $5 million financing in the start of manufacturing for their drug AKTX 101 signals that the stock has finally bottomed out.
And right off the bat, I have to say, the core insight here is sharp. It's really compelling.
It is. The piece zeroes in on this major disconnect. You've got institutions paying 38 cents a share, while the stock is trading on the open market for, 26 cents?
Exactly. That arbitrage is the hook. It's a great foundation. But to really make this analysis powerful, we need to build on that foundation and show clear causality, not just correlation.
Okay, so let's get right into it then.
The analysis would achieve, I think, much greater logical coherence by positioning the GMP manufacturing as the reason institutions paid that price, that 38 cents a share.
Instead of treating them like two separate pieces of good news.
Yes. Right now it feels like, hey, they got $5 million. And then, and also they started manufacturing. They're presented as distinct facts, which kind of weakens the story.
I see what you mean. The section on smart money focuses almost entirely on the price gap, the 38 versus 26 cents.
Right, but it doesn't explicitly state that the confidence from those institutions came directly from the plan for AKTX 101 production. It's missing that direct link.
And just to clarify, GMP manufacturing, good manufacturing practice, that's the big regulatory step up, right? It's where you prove you can make the drug consistently and at scale to FDA standards. It's a huge de-risking event.
It's everything. It's the difference between a science project and a real commercial asset, and that's why the smart money would pay a premium. So the suggestion for improvement here is to reframe the entire opening.
Okay.
Stated directly. Say that these investors committed $5 million at that price because they had assurance that the cash would immediately unlock that manufacturing step.
So you move the argument from just a simple trading opportunity, a price discrepancy, to a narrative about validated execution.
Precisely. It's not they bought low. It's they bought a key operational milestone at what they saw as fair value. It completely changes the thesis.
So, for a concrete example, instead of having the manufacturing update as sort of hidden news later in the piece,
you bring it right to the front, you integrate it into the very first section.
You could open with something like, the smart money didn't just buy $5 million of dilution, they bought a clear path to GMP manufacturing for AKTX 101.
Yes. Paying a premium of 38 cents that reflects their confidence in the immediate execution announced on December 23rd.
That language immediately justifies why there's a price gap. It's not just random market noise. It's a value judgment made by people with deep pockets.
It makes the whole argument a single, strong line of reasoning. It establishes that 38 cents isn't just resistance. It's a fundamental floor based on a tangible event.
That definitely strengthens the core thesis. It also anticipates a key question, which I think leads us to the second point of feedback.
Which is that you need to show you understand the other side of the trade.
Exactly. To elevate this from a good trade idea to a really robust investment thesis, the analysis has to proactively address why the stock crashed to 26 cents in the first place.
You can't just write it off as panic selling.
Right. The piece does a great job identifying that 30% arbitrage opportunity. But the weakness is that it kind of downplays the significance of the delusion itself. It calls the $5 million a survival signal, but it doesn't really detail what survival means in this context.
And any skeptical, experienced investor reading this is going to immediately think, okay, but why was it in survival mode to begin with? Real selling pressure, especially in microcap biotech, it comes from real concerns.
Things like cash burn rate, or a history of dilution, or maybe some unfavorable terms in the offering itself.
Exactly. And if the analysis just skips over those, it risks losing the most sophisticated part of its audience. You have to demonstrate you've considered the bear case.
So the suggestion here is to add a section, maybe a brief one, that shows an awareness of the risks that led to that price drop.
Acknowledge what the bears are betting on. Maybe the historical difficulty of getting this drug to market, or what the cash burn will look like moving forward. You have to lay those concerns out on the table.
Before you dismantle them with the new information.
Precisely. It signals to the reader, I've thought through the worst-case scenario, and here's why the new data makes that scenario much less likely.
We could even use a concrete example from the analysis itself. It points out that the market cap, about $9.4 million, is barely above cash value.
Right. And that's presented as a bullish point, which it is. But you can also use it to frame the risk.
How so?
Well, you could add a small segment that asks, what risks remain even with this new cash? And you acknowledge that the market is essentially valuing the core asset, the drug itself, at almost zero.
Ah, I see. So the implication then becomes that the current valuation is only justified if you believe the drug is worthless.
Exactly. And then you pivot to say, but the initiation of GMP manufacturing is the first concrete step that proves the asset is not worthless. It directly refutes the market's implicit valuation.
That's much more powerful. It shows you're not just looking at a chart, you're thinking about the fundamental business. You're playing chess, not checkers.
It deepens the analytical quality immensely. And that sort of disciplined thinking needs to carry all the way through to the end. Which brings me to the third and final point.
The conclusion and the price targets.
Yes. The effectiveness of the long-term potential here is, I think, diminished by the really abrupt shift in those targets and some of the language used in the conclusion.
I felt that too. The body of the analysis sets these very clear, measured short-term goals. 38 cents, 50 cents. They're logical, they're based on the institutional price and technical levels.
They make perfect sense. But then you get this sudden, unexplained jump to a $3.30 analyst target. It's jarring.
It creates this massive leap in expectation, and the language kind of shifts with it.
That's the other part of the weakness, the tone. The conclusion uses phrases like, the risk-reward here is insane, and this call to action, let's get this to $1.
Which undercuts the very measured, data-driven foundation that was so carefully built in the first two-thirds of the piece.
It really does. It starts to feel more promotional than analytical. And a professional investor might see that tonal shift and dismiss the whole thing, no matter how good the initial data was.
So the suggestion is to keep the conclusion consistent with the analytical tone of the body.
Absolutely. And when you talk about that big 330 target, you have to link it explicitly to future milestones.
It has to be framed as a consequence of successful operations, not just a pie-in-the-sky number.
So, for a concrete example, instead of that promotional call to action, you could replace it with a strategic summary, a summary that lays out 3 distinct tiers of upside.
Okay, so tier 1 would be
The immediate one, closing that gap from 26 to 38 cents. That's the institutional validation.
Tier 2 is the technical hurdle at 50 cents, based on market structure.
Right. And then tier 3, that's the big one, the $3.30 target. But that one needs a heavy qualifier. It should be explicitly tied to, successful progression after the GMP manufacturing.
That makes so much more sense. It validates the big target as a real, though ambitious, operational goal, not just market hype. You could even write something like, the data shows a clear path to institutionally validated pricing at 38 cents. And while the long-term $3.30 target is compelling, it only becomes relevant once the execution phase, initiated on December 23rd, yields the next round of successful clinical data.
That's perfect. That phrasing maintains the bullish stance, but it grounds the ultimate valuation in real-world steps that have to happen. It's disciplined. It tells the reader that the journey to $3 requires a fundamental transformation, not just a technical breakout.